Have you ever driven by an apartment building and been like, oh man, I wonder what it'd be like to own that and have all that monthly cash flow?
Owning multifamily real estate is the fastest way to build passive income.
Which can basically set you free.
Yes, and along the way, you're building long-term wealth. In fact, 90% of millionaires became millionaires because they invested in multifamily or just real estate. So now that you're gonna get started, let's break down the two primary strategies for apartment investing. The first one is stabilized. Stabilized means it's already performing. So you basically put your cash in and you cash flow from day one. The second one is a value add. Value add means you're coming in and you have opportunities to add value. Pretty simple, like the way that it explains it. But you're coming in, whether you're increasing rents, doing some renovations, whatever it is, you're adding value, and on a long enough timeline, that value catches up with you, money, right? Today, we're gonna focus on a stabilized asset, one that's already performing.
All right, so for stabilized, there's really three basic numbers that we're gonna talk about: revenues, expenses, and debt service. So to illustrate this, we feel like it's easiest if we show you an example.
Oh, whiteboard opportunity.
Okay, so let's talk about a 10-unit property. So let's just say, for example, the rents and the units average $900 per month. So the first thing we're looking at is, what is the monthly rent? In this particular case, the monthly rent's gonna end up being $9,000. When it comes to multifamily apartments, we're always gonna annualize it. So really what we're talking about is $108,000 of revenue every year in rents. All right, so one of the main numbers when it comes to apartment investing is net operating income, also known as NOI. Let's break it down. So the net operating income is basically the rents that are coming in less the operating expenses going out. So in this example, what we're looking at is annual rents of $108,000 minus a vacancy factor of, let's say, 5%. So our net rents are gonna be $102,000 and change. Let's say our expenses are $45,000. That means at the end of the day, our net operating income is just over $57,000. That represents how much money comes into the business in a year before paying the mortgage payments. All right, now let's just really quickly cover, like, what are some of the main operating expenses you would expect to see when it comes to apartment buildings? We're gonna have property taxes, insurance, property management, because we are never gonna tell you that you should manage your own property. In fact, we tell you should do the exact opposite if you wanna have time, location, and financial freedom. But you're also gonna have marketing expense, maintenance expense, and utilities. It's funny, a lot of people come into this being like, oh yeah, I totally wanna get into my first building, 100 units, because a lot of the gurus out there talk about, oh, syndication, and you can get in your first deal, 100 units, and it's like, it's so unrealistic. Like, people literally never actually get started when they do that. So what we've seen, all the students that we've trained and coached over the years into actually closing their first, second, and third apartment buildings, they're almost always starting somewhere between 5 and 15 units, actually 5 to 20 units. Yeah. That's the most common place to start. The whole idea is just get into the game quickly, because you will learn so much, you get credibility, you get confidence, and it's much easier to then scale up to bigger and bigger units. So I think the most common place people start, but they actually start and close, is really in that small, 5 to 20 units range.
Yeah. I'd have to agree. And from that syndication perspective, just my 2 cents on that is, you want to learn the habits and behaviors and routines of managing an asset on a smaller scale before blasting into 100 units, right? Especially when you have other people's money at play.
Totally.
Hey, if you are not sure, should I do syndication? Like, should I get into a 100 unit and do the syndication deal, or should I get into a 5 to 20? Then comment below and we'll give you our opinion.
Okay, now let's talk about, like, what is everybody in this for? It comes down to the actual cash flow. How much money do you have in your bank account that nobody has claim to? It's all for you to quit your job, go on vacation, really do whatever you want. So let's break that down. So cash flow is your net operating income that we covered just a few minutes ago, minus the debt service. Another word for debt service is mortgage payment. So if you think every month when you make your house payment, you're making a payment to the bank, that is called debt service when you get into apartment investing. So you have your net operating income, that was $57,000 and change, minus whatever the mortgage is gonna be, and that's gonna equal your cash flow. Now your cash flow is your net spendable income. Okay, so for the purpose of this example, let's just give you, like, what are some of the assumptions that are in play to create the numbers that we're gonna see next as far as the mortgage. So for the mortgage, let's just say, for example, that we're buying the property for $750,000, okay? That means it was $75,000 per unit. All right, so when it comes to apartment investing, commercial loans, it's not as common to get an 80% loan the way it would be if you're buying a 2 to 4 unit. So we're gonna use a 25% down payment, which is more reflective of what you'll see in the market when it comes to apartments. The other thing we need to take into account is the amortization period. Well, what the heck is that? So if you think about your personal residence, if you own a home, you've probably heard of a 30-year fixed rate loan. That means that it's gonna take 30 years of making the same payment every month to basically pay the mortgage completely to zero. When it comes to apartment investing, a 30-year term isn't unheard of, but it's kind of uncommon. More realistically, you're gonna see 25-year amortization. Well, how does that impact things? Well, if I have to pay off this building in 25 years instead of 30 years, it means my payment is gonna be higher. And my only point in saying that is that you don't wanna ignore amortization period when you're analyzing the numbers, because it really will truly have an impact on what your net cash flow is, because your debt service is higher the shorter the amortization period is. And then finally, let's just say for the purpose of this example that we're using a 4% interest rate. All right, so with those assumptions, as far as the mortgage payment, what we're looking at is annual mortgage payments that come out to be approximately $35,600. Now, if you're like a super number geek like me, you're freaking out about this number because you know it's not to the dollar. I know, just trying to make it basic and simple so everyone can get the concept. So don't worry about it if the numbers are a little bit off. It's just to make things nice and simple and even. All right, so in this case, we had net operating income of $57,600. We had a mortgage payment of $35,600, which means at the end of the year, our net spendable cash flow is $22,000. That's how much money you have left over to put in the bank, go on vacation, put in savings, or start working towards leaving your job. All right, and then finally, of course you wanna know when you're getting into investing, well, how is your money working for you? And that is absolutely something you should be asking, because you don't wanna put your money into something that doesn't have a return that makes sense for what your goals are. So let me give you an example of that. Let's just say, in this particular case, I wanna say 25% down payment was something like 185, 190,000, something like that. But of course, when you go to close, there's gonna be things like closing costs, financing costs, etc. So for the purpose of this, we're gonna round that number to 200,000. So let's say our total investment in this property is $200,000. And we have $22,000 coming in at the end of the year, or by the end of the year, in cash flow. Now, of course, that's this year and next year and every year after. Naturally, you're gonna go ahead and do those rent increases, so your cash flow is probably going up. Let's just keep it simple. Let's just say every year we're gonna get $22,000 of net cash flow at the end of the year for a one-time investment of $200,000 of capital. Well, how is that money working for me? If you wanna calculate it, you're gonna basically take that $22,000 annual cash flow and divide it by the amount of money you put into the property. In this case, $200,000. So in this particular example, that means your cash on cash return is 11%. All right, now don't freak out if you're like, I don't have $200,000 of cash to put into a property. Most people don't when they're just getting started, and that's totally fine. That's part of why Jen and I teach you guys, like, don't bother with going with syndication and big buildings and make it super complicated. Find a couple of people, 2 or 3 people, and partner up together, put your money in together, operate the property together, and that's a way for all of you guys to get started and get in the game.
That was an awesome breakdown. $22,000 in annual cash flow and 11% cash on cash return sounds pretty good to me. I don't know about you. We often get asked now, how much, if I'm gonna use like a rule of thumb, a little ninja hack, how much can I bank on cash flow per door when it comes to apartments? And like our average, we look at about $100 to $150. Is that for stabilized?
Yeah, for stabilized.
Okay.
For stabilized. Obviously, when it comes to value add,
right,
it's a different game.
Yeah. So in this example that we just walked you through, we were going through stabilized.
And then the other question we get asked a lot is, well, what should I be looking at as far as cash on cash return? It's, with 2 to 4 units, the numbers actually look sexier for 2 to 4 units. Per unit, you make more on a door. You have a higher cash on cash return, but it's very difficult to scale because what are you gonna do, go buy 100 duplexes, right? So it's great when you're getting started, but you really wanna scale, the numbers just shift. But when it comes to apartments, like what kind of cash on cash should you be looking at? Like we wouldn't look at anything that had lower than an 8% cash on cash return. So when you're looking at different deals, you're trying to figure out like, well, how do I even know what I'm looking at? 11% cash on cash would be fantastic for an apartment building. I wouldn't say it's super common. It really, and the point was to just show you and illustrate how the numbers flow. But somewhere between 8 to 9%, is considered pretty good for an apartment building.
If you do want to get into multifamily real estate investing, but you're not sure what's the first step, the second, or the third, you can click the link in the description below and a member of our team will hop on the phone with you and talk about your goals, your resources, and how we can hold your hand and get you to where you want to be.
The other thing we want to tell you is that we have a free Facebook group. It's called Multifamily Real Estate Investing. So if you want to be around people that are like you, on the journey, looking to learn, come join us in that Facebook group. We do tons of free education and content there And every week, Jen and I make ourselves available for a question and answer session. It's live, it's in Zoom, we're face to face. You gotta come to the Facebook group, register, go to events, and then we'll see you there. But any questions you have about real estate, we're there to answer them for you.
Hey, if you want to learn more from us, then watch this video right here on how to get started in apartment investing. And we'll see you next week.